Stock market is where investors connect to buy or sell their investments on companies that are publicly listed on the stock exchange. So stock market is like your normal grocery store where you can go and do or buy your groceries. It's just that in the stock market, you are buying companies that are listed in the stock exchange. So you don't need to be an investor to start buying stock because it's open to everyone. Though the stock market is open to anyone, it's very important that you familiarize yourself with the strategies that will help you become a better stock market investor. Learning on how to invest in the stock market is very important because I can tell you that there are so many people that are making wrong choices in the stock market that ends up costing them lots and lots of money, which is not good, guys, because I definitely think that there's so much that you can learn that can make you avoid losing your money in the stock market. Guys, there are so many people out there that are successful today because of the stock market. There are so many investors. If you are to go to Google and just do your research, you will agree with me that you can be a successful stock market investor, as there are so many people on the net who have made it or who are successful today because of the stock market. Otherwise, guys, with all that said, allow me to welcome you to yet another awesome video. Now, on today's video, guys, I'm very excited because we'll be talking about how you can invest in the stock market. And of course, we'll be diving through the depth of this topic and checking as to what are the things that you need to look out for, what are the things that you need to research about. And to be specific with you guys, on this video today, we'll be looking at the key terms that you need to use that will help you analyze a company better. We'll also discuss how you can analyze a company by just checking their financial statements. So we'll go through some of the important things that you ought to check in the company's financial statements that can help you make a precise decision when investing in the stock market. Not only that, guys, but we'll also check number 3 on how you can diversify your portfolio, because you remember that this is one of the questions that especially as beginners, or especially most beginners, would want to ask as to how can they diversify their portfolio. So we'll also touch base on that, and I'm sure that those that have been asking this question for quite some time, they will definitely get an answer, and I'm hoping that they will be able to diversify their portfolios in a correct manner. Now, the fourth thing that we'll look at on this video, guys, is how a sector's growth potential can help you generate tons and tons of money in the stock market. So that's one of the topics that I'm very interested in talking about, because with these, guys, I can assure you that you will be very excited and you will be able to start generating tons and tons of money through the stock market. Now, the last thing that I will discuss with you on this video as a bonus is that, guys, I will share with you the 6 best sectors with great potential in the future. So if you are to start investing in those 6 sectors that I will share with you at the end of this video, I can definitely assure you that you will make massive returns in the near future. So watch this video until the end, because, guys, like I said, I definitely believe that after this video, you will be able to invest in a stock market in a better way. And not only that, you will get the top 6 sectors that I believe that they will give you good returns in the near future. Otherwise, please note that I'm not a professional financial advisor. If you seek professional financial advice, do the right thing and go consult the professionals. Otherwise, without a waste of time, here are the key terms that you can use to analyze a company or a stock that you wish to own. Now, the key term number 1 that I want to discuss with you is current ratio. So this key term, guys, or the current ratio, measures the company's ability to pay short-term obligations. Anything above 1 is considered to be a good ratio, whilst anything below 1 is considered to be a bad ratio. But sometimes it will depend on the industry or in a sector, because in certain sectors it is possible that you'll find that majority of the companies will have a current ratio of less than 1. So you need to go and do your own due diligence and check as to why is a certain company having a current ratio of less than 1. Don't just conclude and say that this company does not have a good current ratio by just looking at the fact that it's less than 1, but it's important to go and do your own due diligence and check why the company has a current ratio of less than 1, and also go and compare it with its peers. But otherwise, you would not, on a nutshell or on average, anything or any company with a current ratio of less than 1 is considered to have a poor current ratio. Otherwise, the formula to calculate this current ratio, guys, it's very simple, because it's just current assets by current liabilities. And of course, the current assets and current liabilities, you would basically find this on the company's financial statements. So when you get those two totals, the current assets and the current liabilities, you then divide the current assets by the current liabilities, and if you get a ratio which is more than 1, then thumbs up. But if you get a ratio which is less than 1, you need to go and check why this company is having a current ratio of less than 1, and also check it against its peer. This is very important, guys. So it is important that you know the current ratio of the company that you invest in, because it shows you how the company is able to pay its short-term obligations. Now, the second key term that I quickly want to discuss with you is the PE ratio. Now, a PE ratio is a ratio that is used to value a company. It can also be used to compare a company against its historical record. A PE ratio can reveal how cheap or how expensive a company is when comparing it to its peers or to the companies in its industry. So a high PE ratio could mean that a company is overvalued, or investors are expecting high growth rates in the future on that stock. So like I said, with the current ratio, it's important that you find out why, even on this case, this company would have a high current ratio. Not because that they are overvalued, but because they are expected to perform way better in the near future. So it's the same with the PE ratio that's very low. You should go and do your own due diligence and check as to why is this company having a PE ratio which is very low. So you should go and check that company against its peers or the companies in its sector or industries, and check if their PE ratio is ranging close to the PE ratio of the company that you wish to buy. And something that I should note, I think, to all of you, and I think this question was asked previously by one of the investors: if a company has got a negative PE ratio, it means that that company has been losing money in the past 12 months. A negative PE ratio just simply means that. It just simply means that the company has been losing money in the past 12 months. Otherwise, for you to calculate the PE ratio of a company, you take the company's share price and divide by the company's EPS or earnings per share. And of course, earning per share, you get this from the company's financial statements, but it can also be calculated, guys. But to simplify your life, you can go get the EPS or the earnings per share on the company's financial statements. Otherwise, an average PE ratio is around 15. So anything below 15 might mean that the company is undervalued, whilst anything above 15 might mean that the company is overvalued. But like I said, it's not only that. You might find that a high PE ratio might mean that the company is set to do very well in the future. So you need to go and check and do your own due diligence and check as to what's causing that company to have a high PE ratio. Otherwise, the last key terms that I want us to look into are the return on equity, return on invested capital, and return on assets. The reason why I'm covering these three key terms at once is the fact that they both measures the management effectiveness in a company. Now, with the return on invested capital, anything below 2% is regarded as poor, whilst anything above 2% is regarded as good. So it's important for you to know the return on invested capital of the company that you wish to own or the company that you are planning to buy. Now, with the return on assets, anything below 5% is considered to be poor, while anything above 5% is considered to be good. And with this one, or on this one, anything above 20% is considered to be excellent. So it's important for you to also know the return on assets figure of the company that you wish to own. Now going to the last key term, which is the return on equity. Now on this one, if the company that you wish to own reports a higher return on equity than its peers or than the companies in its industry, then it simply means that that company has got a good return on equity. But remember, it has to be an average. So you need to go and find out an average return on equity on the companies that are on the same sector as the company that you wish to invest your money in. If the return on equity of the stock that you wish to own is higher than that of its peers, then that just simply means that then this is a very good company that you ought to put your money in. But if it's lower, then I guess you have to dig deeper as to why that company is having a lower return on equity when comparing it to its peers. All these key terms that I just discussed with you will help you analyze a company in a better way. But please note that these are not the only key terms that you can use out there to analyze a company. There are many more other key terms that you can use, but these are some of the important key terms that I believe that they can help you make a precise decision or a precise choice when choosing the right company you wish to invest in. Otherwise, guys, besides the key terms, the second thing that will help you when choosing a better stock to own is analyzing the company's financial statements. This will help you track the company's performance, and this is where you find some of the info that will help you identify some of the key terms that I just discussed with you. So on these financial statements, here are some of the things that I believe that are important for you to go and check. Now, the first thing that you will check, of course, is the total assets. And the second thing that you will check, of course, is the total liabilities. Then another thing that you will also need to check is the total revenue. And of course, you will have to also check the EPS or the earnings per share. Now, lastly, the last thing that you would need to check, of course, is the cash and cash equivalent. Now, with the total assets, of course, I've already told you that you need to go and check if the company you wish to invest in, if whether they have more assets than their liabilities. This is very important, guys, for you to check the total assets of this company against their liabilities. And of course, as an investor, on average or on a nutshell, you would want to invest in a company that has more assets than their liabilities. So you need to go and check this figure on their financial statements, because then that will help you determine even key terms like the current ratio that I have already discussed with you. Now, with the earnings per share, you need to check if it is increasing every time this company that you wish to own release their statements. If it's increasing, then it's a very good sign that this company, guys, is becoming more and more profitable, which is a very good thing, and which is something that attracts investors into coming and invest in a stock. So it's very important that you track or you check the earnings per share on the financial statements of the company you wish to own. So same with the total revenue, you would want it to increase every time the company that you wish to own reports or release their financial statements. If it's increasing every time they release their financial statements, then this is a very good sign, or that's a very good sign to say that this is a very good stock that is ought to do well in the future. Now, with the cash and cash equivalent, a good company ought to have cash at hand, as it offers the highest level of liquidity to the management of the company, as the money can be used to pay the company's short-term obligations and operating expenses. This is one of the things that you would need to go and look into when you check the financial statements of the companies you wish to own. Because remember, a company with a healthy balance sheet of cash and cash equivalent is perceived to perform well in the future. Otherwise, the third aspect that I want to discuss with you on this video today is the industry's growth potential. As an investor, I'm sure the main reason why you are investing or you plan to invest in the stock market is that you make good returns in the near future. What if I tell you that for you to get those good returns, you need to invest in industries or sectors that have good future potential? This is very, very important, guys. For you to make it big in the stock market, you need to invest your money in sectors or industry that are set to do very well in the near future. That is how you'll be able to generate those good returns that you want. Investing in all sectors won't guarantee you good returns in the near future, but I can tell you that investing in sectors that have good growth potential can guarantee you good returns in the near future. So this is very important, guys. It's important for you to identify these kind of sectors that you can go and put your money and get good rewards in the near future. Otherwise, going to point number 4 that I believe that it can help you become a better stock market investor is how you can diversify your portfolio, or how to diversify your portfolio. And I know, of course, those who just recently started their stock market investing journey, you have been told that diversifying your portfolio is what will make you succeed in the stock market, which I also agree. But one thing that I also want to highlight on this part is that, guys, you need to make sure that you don't end up over diversifying your portfolio. So what do I mean by over diversifying? So what I mean is that don't end up having or owning so many stocks in your portfolio in a way that, guys, you will end up not being able to catch up with what's happening in the companies you own. Having so many companies in your portfolio decreases the chances of you making tons and tons of money, because I will tell you this, guys, you need to be up to date with the stocks that you own. You need to know the latest updates, the latest news that are happening around the stocks you own. Now imagine if you own 20, 50, 100 stocks. Are you going to be up to date every time with the stocks that you own and make precise decisions? Because I can tell you this, there are some news that come out in the stock market on certain companies that increase the stock price of those companies by 10% in one day. Those news, they can even positively impact the stock price of that company to go up by 50% in 1 week. Now imagine if you own these 150, 30 stocks. If you are to miss this kind of news, you will regret, because whilst other people were adding their positions when those news were released, you were busy checking probably other companies that you own and missed this good or these headlines that made the stock price of the companies that you are owning go up by more than 50% in 1 week. So it's very important for you not to have too many companies in your portfolio, as this can disadvantage you when it comes to being up to date with the stocks that you own. So me personally, I definitely believe that as a beginner, I think try not to exceed 10 individual stocks, as this can make you miss big opportunities that can make you become independently wealthy through the stock market. So it's important, guys, that you make sure that you don't have too many stocks in your portfolio. Otherwise, guys, going to point number 5 that I want to discuss with you, and of course this is the best sectors that you can put your money today and reap good rewards in the near term. Now I won't go into detail on these sectors. I'll just give you these sectors, and I expect you to go and do your own due diligence and check which companies to buy in these sectors. And of course, those of you who've been following me for some time, you will even know the kind of companies that I have maybe in these sectors that I've shared with you on this channel. Now the 6 sectors that I believe that are going to do very well in the near future are as follows. The first one is the EV sector, followed by the energy sector, then 5G technology sector, then cyber security sector, then online streaming sector, then last but not least, the cannabis sector. So all these 6 sectors, I definitely think that if you are to invest your money onto these sectors, you can definitely get or reap good returns in the near future. Otherwise, guys, with all that said, allow me to tell you this one last thing to say, that, guys, for you to make good returns in the stock market, you need to hold the positions or hold the stocks you own for a longer term. There's no way around that. So forget about the day-to-day movement in the stock market, but rather focus on the long term. Yes, the stock that you own might go or drop down by 40, 20, 30%. It does not matter. As long as the fundamentals of the stocks are very strong, I definitely think that that stock will recover and will do well in the near future. Otherwise, guys, I make tons and tons of stock market investing videos, and if you think that this video was amazing, please don't forget to hit that like button. And if you are new to the channel, please don't forget to hit that subscribe button and click on the notification bell so that YouTube can notify you every time I release a video. Otherwise, guys, that's all from me today, and I wish you nothing but the best in your stock market investing journey. See you in my next video, and God bless you all.